Time now for easy to follow futures trades and market movers from CME Group.
Welcome to Market Movers. I'm Jim Murio, and this is an historic day as the UK triggers Article 50, sending Brexit on what we're told is an irreversible path. Today we're going to talk about gold as a way to hedge risk against things just like this. Joining me today is Chief Investment Officer at Kingsway Asset Management, Scott Martin.
Hi, Jim.
Okay, Scott, markets did move, particularly the pound, particularly the euro, but they didn't move that much. Why?
Well, because I think this was baked in. I mean, this was something we were waiting for after we saw the vote last year, which finally went through, to your point, supposedly irreversibly. But the market reaction was muted because I believe this was already something we've dealt with.
I do too. I think I'm the only person who was surprised. I kept thinking they were going to kick the can down the road, and they didn't. And I'm glad I didn't trade it too much because I would have been wrong.
And to your point, the real reaction has been in the currency, frankly. The currency has been smoked since that vote last summer, not so much in the equity side.
No doubt about it. Now, will we look back at this as the beginning of the end of the euro? Is this a big deal?
This is the end, friend, but this is something that's been coming along for so long, hasn't it? I mean, the talk of the end of the euro, the talk of the breakup, all the political strife that's been going on in the last several years, let alone last summer with the Brexit vote, this is just more of the same in my opinion.
I think I agree. I'm not sure that a marriage from Germany and Italy can last forever. We'll see.
Nothing lasts forever.
Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to manage risk or create additional trade opportunities, not as trade recommendations. Prices and movements will vary in the markets. When we're looking at this, the June gold contract is trading at about $12.55. Scott.
Gold tends to be fun to look at around these times, especially what's going on in Europe and DC. So, Jim, I'm actually looking today, looking at the charts and seeing that rally we've had in March so far, and just seeing that maybe we could see a little retracement. Maybe things are settling down. Therefore, a put spread is on our hands here, specifically the 1200 to 1225 put spread. This is what the underlying trading at about 12.55. So yes, it is a little far away, but it's incredibly cheap. 2.2 ticks is what it'll cost you to put this on as an expiry of April 21st. It risks about 220 to make a potential 2280. Yes, it's far away, so you don't have to exactly hold it for that whole period up to expiry or hold it for the whole fill of that spread. But I believe this is something you can manage around, given that you can put on for relatively low cost.
Okay, I'm going to go against this trade, but I'm tell you the things I like about it. I do like that it's inexpensive. I do like if the dollar holds in at this 99 level, which seems to be bumping up against support and starts to rally, gold could get hit. I don't think it's the right trade right now. I'm looking at the chart, and I see the consolidation that's happened the last couple of days, and to me it feels like it's gearing up for a pop higher. So I'm looking at buying the week 3 April gold, 1275, 1,300 call spread for 3.7 ticks. This trade also has an expiry of April 21st, and it's off the GCM underlying. It risks $370 to make a potential 2130. Something I'll point out in gold, though. Remember that the calls are usually more expensive than the puts because in gold, disaster exists to the upside. If there's a rush for gold, people are crawling all over each other to get it. It's usually not that way when they're selling it.
Especially in these times right now, where any day now can bring a surprise, which obviously may benefit the GC. But in reality, I think a lot of that stuff, at least for today or tomorrow, or the next day, seems to be out there. So if there's no more disasters until April 21st, which is no guarantee, we could see gold pull back a bit.
Speaking of which, the 10-year. Is 10-year still the same pure safe haven, risk-off trade that it was, even with the Fed saying they're going to tighten 4 times?
That's the thing. Back when the Fed was not in play, I don't believe that if you bought the ZN, you had to worry about the interest rate picture as much. Nowadays, with the Fed back on and the promise of, 2, 3, maybe 4 rate hikes left in the year, Jim, I believe that puts a different kind of feel into the ZN trade.
I'm not sure I agree with that. There's going to be 4. No, not with the 4 rate hikes. I agree with your thesis, but I'm not sure there's going to be 4. But at least they're talking about 4 rate hikes, and that matters. Thanks for joining us in this special edition of Market Movers. I'm Jim Murio, where we're helping to make you a better trader.